Hello, this is Jordan. This video is being recorded on the evening of Tuesday, October 11th, 2022. Thank you so much for joining me. In this video, I am going to talk about how gold has actually held up really well when we're thinking about the rise in the US dollar as well as the rise in real yields. So we know that real interest rates are what drive gold. Gold's negatively correlated, and to a lesser degree, also the US dollar. And so in this chart, this is a daily line chart. And so we have gold at the top, and then below in the middle, that's the real 10-year yield that's calculated from the TIPS market. You can get that daily data on treasury.gov. I mean, if you have a Bloomberg and those types of things, when you see those charts on Twitter, that's where it comes from. And then at the bottom, we have the US dollar. And so I'm annotating here the big declines in gold over the last 15 years and how much movement there was in the real 10-year TIPS yield. And so most recently, calculating from the secondary peak earlier this year, gold is down about 21%, or at least down to the bottom. That's how much it fell, down to 1630 or wherever it was. And so gold has declined 21%, yet in that time frame, you can see highlighted there in the middle, the real 10-year yield is up 2.72%. So that's really a significant move in the real 10-year yield. And so and at the same time, the US dollar is up 20%. And so if we look at the other declines in gold and the movements in the real 10-year yield, we can see that gold during this sharp correction is holding up much better. And so those annotations there in black, they show the decline in gold and also how much the real 10-year yield gained during that period. And so if we go back, we can see, I can read these. Let's start at 2008. 30% decline in gold. The real 10-year was up 2.25%. Dollar was up 24% in that period. And just compare that to now. I mean, the real 10-year has gone up even more, almost basically half a percentage point more. Gold hasn't declined as much. Now, if we look at the dollar went up a little bit more during that period. The dollar, if we look at how much the dollar has gone up since gold peaked or since early 2021, over the last 18 months, I mean, that's almost a 30% move. So gold is definitely, based on those two factors, it's holding up much better than it did in 2008. And obviously, it's holding up much better than it did in 2011 and 2012. We're not measuring from the 2011 peak, but I measured from the 2012 secondary peak, that initial crash in gold. Gold declined 36%. The real 10-year was up less than 2% during that period. And at the same time, the dollar was up only 8% during that period. So gold leads the dollar. We know that. And the dollar's big move happened in 2014 after gold already crashed and began that bear market. Now, if we look more recently, we can see, if we look at 2018, gold declined 14%. The dollar was up 10% during that period. The real 10-year was up less than 1%. So that was a sharp decline at the time, but there wasn't as much technical damage as there is now. And then if we look at we can see the COVID crash. Gold declined 12%. The real 10-year was up over 1%. Dollar shot up 9%. Of course, gave it all back really quickly. But coming back to now, if we look at the real 10-year, even if you measure that from the bottom at the end of 2021, that's nearly a 3% rise in the real 10-year yield. And, look, gold is not it's not down as much as it was in 2008 or in 2013. And in addition to that, I mean, look, gold now is trading around where the low was. I mean, that's the vertical line, spring of 2021. When gold first came down to 1675 or 1680, gold's trading at the same level. And since that point in time, you can see how much the dollar has gone up, how much the real 10-year has gained during that period. So, obviously, in a more, I want to say in a more short-term sense or a more present sense, I mean, there's been a lot of carnage in the sector. We know that this hasn't, miners have not held up because gold has come down and costs have gone up. It's a double whammy. But just looking at these factors for gold has held up better than you'd probably expect. And we can see the horizontal line, that blue line, is in the mid 1500s. I want to say it's at 1560 or so. There's a lot of lateral support there. That also comes in right around the 50% retracement from the 2018 low. So that looks to me like it's going to be a really strong target. We're talking about not much more than $100 lower, so it's 6 or 7% potential downside for gold. So I don't want to gloss over that and say that we've bottomed and gold is about to run away here. Clearly, there is a question if it's bottomed or not yet. I mean, there's definitely a case to be made that it can go lower to that 1560 target. But it's clear that if we compare what happened or what's been happening in these fundamental factors to 2013, gold is holding up much, much better. And it's even holding up better than what happened in 2008. And so fundamentally, what is really setting up is, when the Fed has to shift course and when they stop hiking. I wrote about it in my article. You can look at it at TheDailyGold.com. There's two catalysts. We can say 2.5. I mean, before the two major catalysts, we have gold. I should do another video on this. We have the stock market is broken below the 40-month moving average. Look at where gold stocks bottomed when that happened in 1969, 1970. Also, when that happened in 2001, gold stocks had already bottomed. When it happened in 2001, I think gold bottomed almost exactly to the month. I want to say February 2001. So that's kind of a mini catalyst. Then we have the Fed stopping their hikes. And then next year, we're going to see the Fed will be forced into cutting rates eventually. You have to follow the market. There's all this talk that they're going to be tough and all that, but when conditions change and when the market's trading much lower and we're in a recession, of course they're going to be cutting rates. And when inflation is plummeting statistically during that period, of course they're going to be cutting rates. So no one's really thinking about that. But those are the dual catalysts that we have coming. I think the Fed shift is coming very, very soon. And until that happens, maybe gold can test that support at 1560. But nevertheless, in the very big picture here, we see that real yields have increased almost 3%. The real 10-year yield, the dollar has shot higher significantly, and gold is only down, 21% or 22% off its high. If it comes down to 1560, I think it's about a 24-25% decline. So it definitely hurts, but I think it's going to be behind us soon enough. Let me know what you think. I know that was a lot of rambling, but that's how I see these big picture fundamental factors right now. Thanks for tuning in, and I look forward to doing another video for you guys in the days ahead.